welcome everyone to join our webinar today, talking about family foundation from more like a tax perspective. Most of you probably know me. I think we basically send email blasts to our current clients. So here's me and Byron. Byron is a dear client of mine and a friend. I think Byron came to us through Family Foundation, right, Byron?
Yep. Yeah, so really, I heard about Foundation from Paul, our mutual friend, and then over a couple of chats, I kind of got curious of what it is, and he basically recommended you, June, for me just to talk to for both my CPA needs and the foundation. So that's how we got started, I guess.
Yeah, we got started about 2 years ago this time, and we helped you set up your foundation, Inspiral Foundation, right, Byron?
Correct.
Yeah. Besides being the foundation founder, Byron also has multiple jobs, I remember, and have 2 kids and a lovely wife, and I don't know whether you have animals. Very busy life.
Always on the list to be considered, but haven't done it yet.
Oh,
Yeah,
no.
we have different feelings towards pet depending on when you ask us.
Okay. I have a dog and a cat, and all my kids are gone, so I'm an empty nester. So, all right, let's go right to it. What is a family foundation? So, I'm going to give you some academic definition, I guess. It's really a charitable foundation, a charitable organization. So, use the tax code. It's called the 501c3 organization. And the most common one everyone knows is the Bill Gates Foundation. I think that is the I didn't do my research, but I think they are the biggest foundation now, because he donated in the 80s or the 90s. He said he's donating 90% of his assets, so he doesn't want his kids to have so much money that they cannot work. So in a way, a lot of people would think, oh, why that has anything to do with me? I'm doing well, but I'm not uber rich, right? I'm not ultra rich. So I think this foundation, this webinar is to really let everyone know, all my dear clients, that it's not really for the super rich. A lot of you should do it, utilize it as a tax strategy and also as a way to give back to the society. Just give you some very vague statistics to have an understanding why I say that. So in the United States, there's a little bit over 120,000 private foundations, and half of them are family foundations. And the average asset, you want to guess, Byron, of a family foundation, average asset? You want to give it a guess, Byron?
1 million.
It's 5 million.
Wow.
But it's 5 million because, Bill Gates get the average, pull up a lot, right? But there are 2/3 of the foundation, their assets is under 1 million. So you are actually right. So the medium is definitely under 1 million, right? But the average is, is over. So I think it's a charity. So it's almost like when you donate to this organization, is like you're donating to another 501c3 organization like a Red Cross, right? Red Cross is a public charity. I'm sorry, not a private charity. So there's a little bit different ruling there. But the good thing is when you have your own foundation, you actually control how the money is used. So you have a bigger influence on what you do with the money. You control the money while saving a lot of tax. So maybe Byron, you can tell us a little bit about what your thoughts are and why you end up opening up the foundation. You are pretty well to do, but I wouldn't say you would be in the Bill Gates league, right? I'm not trying to.
No, I think I do okay. But the foundation was, like in my journey to find tax effective ways and how do I minimize my tax? How can I control it a little bit better? And I think foundation had that aspect where a lot of times we are already doing charity every year, And it's like, okay, I find some charity I want to donate to, and I donate to them. And with my own foundation, I thought was very interesting because instead of, I'm also into a little bit politics, and we could get that on the side, but I feel like having my own foundation allows me to basically control where I actually donate the money to. And instead of the money being taken by RS, that money is gone, right? I can actually redirect it to myself and then further control where I actually donate that money to. And I thought that was the initial impetus where, hey, I get to control this instead of having IRS do it. I think I do a better job of it. It's kind of like my thought.
Yeah, I remember the word by word you said. It's a family foundation is a vehicle that you can redirect from the IS to the society, right?
Yes.
And
I
because
control it.
Yeah, you think you do a better job than the government.
Yeah.
And
yeah, exactly. They have their own way, but I think I want my donation to actually make an impact that I can feel. I think that's a big part of it.
Yeah. And though you are not at the Bill Gates league yet, but you're thinking like him. He said exactly the same thing. He said that he believed he will run a non-for-profit much more effectively because he's going to run it like it's a business. So he's going to make better use of those money than giving it. And that is also why Warren Buffett donated a lot of his money to Bill Gates Foundation, right?
Right. So, but I'm not them, but I'm just a simpleton where, I want to see, if I'm donating something, I feel like I don't know where it's going, but if I could give it a little bit more meaning, and actually see, if I put effort into it, I could see the outcome a lot closer to me.
Yes. So maybe let's focus a little bit on the tax saving on family foundation. So I always say it's a triple, and I will show you later on how it's quadruple saving. From the, I'm a CPA, so I'm wearing my hat. So first of all, you will reduce income tax at marginal tax rate. So we can take Byron as an example. He lives in California. So his marginal tax rate is 50%. And every dollar he puts into his family foundation, he donates there, he saves 50 cents. That is how effective it is when you first put it away. I also have some clients say, if I pay tax, I only have to pay 50 cents. Now I have to put $1 into my family foundation. I'm still losing money. But guess what? If you think that way, is the glass half empty. The other way of thinking it is, now I have another $1 million in my foundation. I get to control and I get to use it for the better good of the society, right? So you definitely have to have charitable mind. If you're not charitable minded, this is not a tax strategy for you. Just like Byron said, he's already donating. He's already doing a lot of things. Now he's putting this energy into his own foundation to make it even better and saving a lot of tax. The second thing is you can avoid any of the capital gain taxes for your future investment. I'm going to use Byron as an example again. He's a really successful stock market player, let's put it this way. Yeah. So, you make a lot of money, right, in your investment. So if you invest you use your foundation's money to invest, let's say the $1 million he put it there, he can make more money from that and never have to pay capital gain tax again. So that's the second layer of saving tax. The third layer is you basically eliminate estate tax. And that's also why Bill Gates did it, right? Because at that time, he's going to pay, and estate tax rate is even higher than income tax rate. I'm going to test you again, Byron. What's the estate tax rate in California?
Isn't it 50%?
It's more than that.
Oh, shoot.
I mean, there is an exemption, but the exemption is pretty easy to go over. Before 2026, the exemption is right now as a couple is 26 million. But after that, might come down, okay. Right? But after that exemption, the rate goes up really quickly and easily. As a California resident, it gets to 60%, which is higher than your marginal income tax bracket of 50%. Why do I say that if you put money in the family foundation, you eliminate that? Because basically this is your family's foundation. We all know all Bill Gates children are working for Bill Gates Foundation, right? So the whole family still get to control the money, get to control where the money goes to. But there is no estate tax. But technically, it's not their money. So here I want to talk about ownership versus control. Which is more important?
Control.
Yeah. Ownership comes with a lot of tax and headaches. With control, you don't have the tax, and you still get to enjoy all the benefits. That's the way to to put it, right? And here I think we can have Byron go through your mindset again. We have a mission statement here. So like I said, no matter how great a tax strategy it is, you have to be charitable minded. Byron, you want to read that yourself, or you want me to read it?
I don't know. I'm shy.
You're shy? Okay, I'll read it. I will read it. And also the logo I heard was designed by you and your daughter together.
Yep.
Yeah, you have I believe two teenager daughters, right?
One older son and a younger daughter.
I'm sorry.
2 years. Yeah.
Yep. The younger one is going through all the tests to go to college, so I remembered her.
Yeah, okay. We're right in the midst of the process for my daughter right now. So yeah. And this is one of her side projects.
Okay.
To create the logo.
Yeah. Inspiral gives children life-changing opportunities by empowering them to challenge themselves and improve their skills. Our foundation is dedicated to inspire our youth to use their creativity, strengths, and skills to better themselves while also making a positive difference in our society. We are committed to providing educational services, awarding academic scholarships, and hosting competition to encourage our youth to achieve their full potential. I still remember Frank, our tax manager, set this up for you, and he told me how inspired he was to do this kind of meaningful work to help you, to help the society. Yeah, so maybe do you want to get in a little bit more into your thinking, the tax and the other charitable minded thing?
Yeah, I think the foundation was really, I like designs, I like concepts, and coming up with a foundation was actually not easy because there's so many different ones. But I thought that doing something meaningful and giving back locally is all I really want to do with the funds that I put into the foundation. I'm not thinking international. I'm not thinking Bill Gates. I'm just thinking locally. I want to be able to give back, at the local level, and doing my little bit with the money that would otherwise go to IRS. It was kind of like my impetus.
Yeah, when we help other people setting these foundations, a lot of people tell us it's a soul-searching journey for them. Just like you said, like there are so many things we can do, and a lot of them said they did it together with their children, and it's very meaningful and fulfilling.
Yeah, and I'm at that age now to look at estate, not only my own estate, but my bigger family's estate. And actually, there was a very interesting discussion I have with a good friend who is very successful and very thoughtful person who always read books and always thinking. And he was like, how do I make my estate or my he's not thinking foundation per se, but he's thinking generational estates, where how do I give to my family but not break them apart because of wealth management issues. Like if I'm going to give 50% to my son and then 50% to my daughter, is that good for them? And he put a lot of thoughts into that. And one of the things he said is giving money to the kids, too much money to the kids, is actually really detrimental to them. And he gave me one example that really stuck out. He knew someone who's even more successful than him, and this guy had like 5 grandchildren, and he sold some property and then made some profit off that, a couple of million in profit, probably like, let's just say 5 million. He made profit from that. He said, "Oh, I'm going to give it to my grandchildren, so it helps them." And he said that was the worst thing he ever done, because of the 5 children, only one of them did well. The other 5 was either super money, spend all the money, spend it on drugs, partying, luxury life. But only one of them actually made use of the wealth to improve himself. So it was like, that was the worst thing he could have done, is give money too early to the kids. And aside from that, the other big learning I had from my friend is, how can you make your estate bring your next generation together instead of separating them? And there was this whole book that he recommended to do that. But my learning from that is, hey, using a foundation, I can actually ask my family to contribute their efforts to it, and make this a family event that we give back, and all the things we do to make that event happen. You could use the foundation as a focal point. I thought that was very interesting that he didn't think of it that way, but I thought that being able to bring family together is very important, and the foundation is one of those ways.
Yes. Your sister can definitely donate to your foundation and save tax on her return.
Right.
So it's not just you can, family foundation, your whole family can contribute. And you really hit a home talking about how, doing things together with the children and instill your giving, your value to your children is more important than the money you're going to give to them. Now we're getting to a very ideal spiritual.
Not really. There's the other aspect, right, of within the foundation, you could hire help, right? Any organization, any company or organization have a need for people to help run it. So that's where you could, as a founder, owner, you can actually hire people, and these people, I think, June, you might be able to explain it better, but it could be your children to help manage this overall thing. I'm not sure if I.
Your children can definitely be part of it if they are really actively managing it. You're right. So very good. Let's. I'm very inspiring, Byron. So next topic, I think we're gonna talk about who are suitable. It's almost like in the beginning I hit it, right? Is my whole opinion of my 30 years of practice, not only the super rich can do this. And from my experience, most people are hitting the highest tax bracket that are doing this because they really, really want to save tax too. So it's charitable minded and a tax strategy. But I also have people, they're not at the highest tax bracket. They are in their 32 or 35. They're also doing it. So I think over the years, I learned from my people is how much is enough, Byron, right? Some people, I do have clients make 5 million and they still don't think they make enough money, right? And I have people who, when they hit a certain level of income or wealth, they're very content and they want to do more for the society. So here comes again the charitable minded and the tax strategy. There is no hard line here who are suitable. But if you really want me to give you a rule of thumb, basically are people who are hitting the highest tax bracket. And you don't have to be hitting it every year. There are people getting bonuses or stocks or whatever. So certain years, their income are really, really high. And those are the years you can, lever it, right? Put it into your family foundation, do some investment. You certainly need to do charitable things to the society, but you don't have to give it all out to Red Cross the first year. So who are suitable? That's really, I think it's a philosophical question and also about control and ownership. Sure, if you don't even have enough to live yet, you're definitely not going to do this. We understand. Is that called the 5, is it Maslow, the pyramid thing, right? The last one is the self-actualization, Byron. The first one I think is shelter and something. I forgot the five. It's a pyramid. So there are people get to the top of pyramid earlier than other people. Everyone feels differently than how much wealth they need to accumulate, when it's ready. And here I also want to talk a little bit about Byron's. Maybe you can share with us how when you first set it up, you were a little doubtful, like, did I do the right thing? Why should I do? So the first year you actually didn't contribute anything to your foundation, right? It's to the second and the third.
I was a little iffy, and it's like, what should I do? What actually qualifies, and the overall that process. But at the end of the day, if you're qualified, basically think of it like any money that I'm giving as tax. You might have to correct me because I never perfect the numbers. But any number I'm giving, any amount of tax I have to give to the IRS, I can make a portion of that into donating to the foundation, and it automatically that amount that I give to the foundation is automatically subtracted from the tax. I'm sure there's a amount or a threshold that you need to play with, but basically that amount, instead of going that I'm paying to IRS, I'm just redirecting to a charity. That's basically what it is, and that amount is now in your foundation. It's now under your control that you can delegate to future. And to talk about it, let's say I put in 100,000 into the foundation. I subtract that 100,000 from my taxes because instead of going to IRS, it's now going to the foundation, right? Once you have
correction, not 100%. That 100,000 is a reduction on your income, not a reduction on your tax.
Okay, on the income. Okay.
Yeah, so but because your tax bracket is 50%, Byron, so you save 50%, $50,000 in tax, which is huge.
Right. So I'm always horrible with that number. That's why I depend on you, June.
It's okay. That's why you need me.
but whatever amount goes into the foundation, there is the rule that every year you have to give 5% of whatever the total asset of the foundation is.
Yes.
When you think about this, like, oh, why would I want to put money in there and then give 5%? That is no longer your money. If you think about it, it's under the foundation. But if you have let's just say use the 100,000 as the total amount in the foundation. If I have to give 5% every year, it should be a decreasing amount, right? But if you are putting that amount into a brokerage or something where you can buy bonds or something safe, you could do something more not as safe, but essentially you should be able to get 5% easy on the market, right? So if you have 100,000 and you get 5%, hey, what matters is having to give back 5%. So it's like a wash. If you're better,
you are saying as long as your investment in the foundation exceeds 5% annual return, your foundation will never really shrink.
Exactly.
Yeah.
Of course, you have other expenses, but those expenses are most likely things that you want to do, right?
So a small correction.
People, blah, blah, blah.
Yeah, a small correction here again. Not 5% donate to other foundation or other courses. You have to spend down 5%. So spend down 5%. That 5% including your expense.
Oh, okay.
Yes.
I forgot that. I always forget that.
More. You can certainly give more. And also in 1 year, if you give more, the next year you can give less because you have an over contribution. Yeah, it's IS basically the tax code. I hope everyone here understand is written to encourage you to give. And also as a I guess our founding fathers or whatever who wrote those IS codes, they also believe maybe individuals can do better than the government with the money. Okay, I think you actually covered a little of my future topic, which is good. So who are suitable? I think whoever is charitable minded and want to use this as a tax strategy. So just remember, when you put the money in, you're saving your marginal tax rate. And then all the future gain from any of the investment is no more capital gain tax, and then also no more estate tax. So that's how you save tax. Next topic is what should we donate, right? I think we had a lot of conversations with Byron on this, right? So you can literally donate anything. But we just want to say one thing here. I said the triple tax saving, and sometimes it's quadruple tax saving. Here comes the quadruple one, which I believe Byron has a lot in your portfolio. It's called appreciated long-term stocks. So let me use a simple example. Let's say I bought Tesla for $1 many years ago. I'm just kidding. I don't think it was never $1, right? And now Tesla was $1,000, right? When I donate my $1,000, that share of Tesla to my foundation, I got a $1,000 income reduction. So if my tax bracket is 50%, I save $500 in tax. So I saved all the capital gain tax from $1 to $1,000. That is a quadruple. I think it's, and only appreciated long-term stocks have that treatment, and it has to be public traded. If you donate a home, like a property, only the original basis goes to the foundation, not the. What I mean is that your income tax deduction is not the current value. It's just the original basis. Those may be a little bit too, anyone has questions can always ask me. But I always feel the appreciated long-term stock is the best. Actually, I just talked to someone an hour ago. That's what they're going to do. They have a lot of appreciated long-term stocks. So if you have that good problem, it more double the reason for you to have a family foundation. That's also why, Baron, I think it's suitable for you.
Yeah, I have a whole slew on that, but we're talking about.
Hey, come on! Some years we lose, some years we gain, right? Overall you made a lot of money. Come on.
Mm-hmm. My wife likes to challenge me on that. She could do better, but I have to say she's much better at me. I'm very good at picking, but I'm not getting good at exiting. But she's very good at exiting, so I have to work with her now.
Okay, very good. So you guys will be a perfect pair. Let's make some money in your foundation so we don't have to pay tax. Yeah. Mm-hmm.
Yep.
Okay, dokie. So the last thing today I want to cover is some frequently asked question. The one is the 5% spend down rule. Oh, sorry, there is a misspell here. It's RULE, not ROLE. It's okay. So I think I already talked a little bit about it. So people say, oh, you put the money away, there must be some restrictions. So private foundation, family foundation, not many restrictions like public charities, because if you get funding from government, there's a lot of restrictions. This is really your family's money, you donate there. So you have a lot of leeway, but there are certain rules you still have to abide by. And a couple of them, the first one is every year you need to spend down 5% of your net asset. Not your income, your net asset. So let's say Byron, I think put in about 50,000 this year in 2023, right?
Yep.
So in 2024, you have to spend down 5% of that, which is what, 2,500? I hope you can pay me that much. That's a spend down. I'm kidding.
No problem. When I get to 1 million, you can take a lot bigger chunk.
Yeah. So spend down means you can pay your accountant, your attorney, maybe for your children to set up your website. I don't know what that's. It can be an expense. It can also be a donation to other charitable organization, or you set up a scholarship. All these things count, right? I have people ask me, can I just every year just spend down, never donate? Then I say, maybe this is not for you. If that's all you want to do, you want to really take all the money back, never want to give, you might get audited and you're going to have to face some pretty tough penalties, right? So again, it's charitable minded and saving tax. It's 50-50. Maybe not 50-50. Some people more focus on, but cannot be 100% for saving tax. Otherwise, it's not going to work for you, right? So the 5% rule, I think, is very generous. Just like Byron said, the self-sustaining rule, like Byron said, as long as your investments over that 5%, you are good to go. And your family foundation will only be bigger and bigger and bigger, should not shrink. Okay. But some people might want to shrink it. I have clients in my book of business who want to shrink it and close it down because whatever the reason, and they can. They can give out the money. They can pay themselves some, reasonable expenses, reasonable salaries to run the foundation, right? The last one is self-dealing. So paying yourself salary is not self-dealing if you're paying yourself reasonable compensation. But if I own a building and I rent it to my foundation as an office and I charge a rent, that is self-dealing. So when it comes to that, I hope you'll talk to your CPA, talk to us what is self-dealing, what is not. I actually recently have a client, not a client yet, as prospect talking to me. I think they want to do some scientific research. And she says she has a building. She wants to rent it to the foundation, rent free, not charging any money, just for the foundation can use it. Is that allowed? What do you think, Byron? You think it's allowed?
I think so. No.
Yeah, it's rent free. You're not gaining anything from it. So yeah, it's definitely allowed. But self-dealing is a pretty touchy subject, and most people get audited, failed on this one. So talk to your accountant, and also be very mindful that this is still a charitable organization, right? There are certain things you can do reasonably. There are certain very clear things that you cannot do. I think we are pretty much done with talking about because I want to leave a lot of time for Q&A. But Byron, I think I talked too much in the second.
I have a question, actually. I think we kind of touched on it, so I'll just ask the question. Like you said, closing it down, but I'm thinking the opposite. If I'm gone as the founder and I want this to continue for my family, for my next generation or the generation after, how would that work? Is there a need to, is there some type of beneficiary from the ownership perspective? Because even though you're owner, you're not, you're just the foundation owner, but not technically in control per se, right? But how's that going to get changed?
Okay, very, very good question. So first of all, you're not the owner, right? You are only the directors. So when the director changes later on, you and your wife will, it's going to be your son and your daughter, maybe your niece, right? They are directors. So the next generation just naturally take over. So it's not even ownership. It's very simple and straightforward.
Okay.
Yeah, it's basically your, it's like a company, your operating agreement, right? Who is in control, the voting powers, those are the things, not shares. Mm-hmm. So it's very easily transferred down. Right. Okay.
Thank you.
I think I have a couple of, one thing I need to talk about is we always do a family foundation webinar at this time. Why? Because most people like Byron just paid thousands of dollars in tax. I'm not, what do you call? Because in California, you're lucky this year, you can pay tax in October, right? Actually, they extended to November, right? So most of the people, high net worth and high income people just pay their tax. So they still feel that pain. And also you still have time. If for 2023, you want to save that tax and donate to your foundation, you have time to do it. Time is running out though. So here's you have to set it up and donate whatever the asset you want to your foundation by December 31st. And our company actually can help you set everything up for you. It's normally a 3-step procedure. It's quite cumbersome. Like you set one in the state first, the non-for-profit, and then you have to apply for the 501c3, the tax-free exemption status. That's the hardest work. And then you have to go back and certify with the state. But I mean, I don't have to bore you guys with the procedures. Byron, you did it with us. How was the experience?
You guys did most of the work, but the iffy part, when you talked about iffy, that was the part. It's like, do I want to do anything if the foundation is still not qualified as a 502(1)(3)?
Okay, the tax exempt. Yeah. Yeah.
So tax exempt. So I wanted to wait for the exemption to actually get from IRS approved before I put money in, because I was still iffy before that.
Yeah. So it's very good. If we set the foundation for you now, like in November, you're not gonna get the IRS approval on the tax, the exemption, approval this year. No way, because IS is not that fast, right? The fastest so far we got is 1 month's approval, but most of them 3 to 6 months. So you probably will get your approval next year in April or May. But the deadline for you to get that approval is next year filing deadline, which is like November 15th of 2024. So you can definitely put money in your foundation this year and get because your filing deadline is October 15th for personal and November 15th for the foundation. So here, I just want everyone to know that you still can do it. You have time, and have confidence in us. We're going to get you the exempt status. We have not failed yet. And also because it's a private foundation, is really not much of a scrutiny, just making sure put all your paperwork in order, which here's our expertise. That's what we do for a living, right? So anyone is interested, I think later on we have a link for you to schedule a whatever call with me to talk about the details. I think that's pretty much it. Oh, I need to do a little bit of rap sheet about us. Okay, let's see. So at Zhou Agency, it's my company. I have it for 30 years. So I always believe in tax efficient strategies instead of just filing paper for people. And that is also why we don't just file your tax. We give you strategy, and we also execute some of the strategies. That is why I also have a real estate and an insurance arm. So that's a 2-minute, not even 1 minute elevator speech. How was that? Good? All right. I think we get to the Q&A now, right? Christy, are you going to move the question to, or I'm going to read it?
Yeah, I mean, they're like 10-ish questions.
Okay, I will read it. If people, you can, all the audiences, you can, on the right, there's a Q&A, you can look at it. And some of them, maybe Byron can help me. Hi, Ozzy, how are you? So basically, Ozzy's question, how do you avoid capital gain tax for future investment in the foundation? Because the foundation is a non-for-profit organization. So all the money you make in there is not subject to capital gain tax. So you don't have to do anything. It's just that's how the tax code is written. Because the assumption is you're going to use all the money for charitable purposes in the future. I hope I answer your question, okay? Oh, Ozzy is very, very, how much it costs to set up a foundation? Government fees altogether is about $1,000 at the state and the federal level, a little bit less than $1,000. Some states might be more, like California, but most states are under $1,000. And if you use our service fee is $6,000. So altogether is about $7,000 out of your pocket. And because you asked that question, annually to maintain the foundation is about $2,000. And all these can be expensed from your foundation. And the next one is, could you explain the quadruple tax saving again? Basically, when you put money in your foundation, you save income tax that year at your highest marginal tax bracket. And then all the future gains from your investment in the foundation is not subject to capital gain tax. And it basically eliminate the estate tax when your children take over the foundation. The last one is if you donate appreciated long-term stocks, public traded ones, to your foundation, you also avoid the capital gain tax on that stock. That's the triple. Not triple, quadruple. The next one is, what's the difference between setting up a family foundation versus a trust? Really good question, okay? So I think you're asking the difference between a foundation and an irrevocable trust, right? So an irrevocable trust also is you basically put the money in the trust, you no longer own it. It's no longer under your name, but you 100% control it. It's almost similar in that sense as a family foundation. But the difference is in the trust, you still have to pay all the taxes for any of the capital gain. If you put a property in your irrevocable trust, the appreciation is taxable. Everything you put stocks in there, the appreciation, and also estate has to file its own tax, and the tax bracket is pretty high. Those way very quickly up to the highest bracket. And also when you put the money in the irrevocable trust, there is no tax saving. But the good thing is has nothing to do with charitable, mind, unless it's a charitable remainder trust. Trust can be very, very complicated. If you do a charitable remainder trust, then it has both a little bit of the family foundation and the trust combined effect, right? So here comes, it's very complicated. I won't be able to, give you a very in-depth explanation. One thing I do want to say, people always think it's something they either do one or the other. It's definitely not mutually exclusive. I just had some calls with Byron recently due to some good fortune, right? Some money coming to you. So you definitely will need the living trust, irrevocable trust, the family foundation. All these tools are there for you. So I just want to say that it's not either or, it's and. The next one, Byron, that's for you. Can you see it, Byron?
Yes, I can. Instead of I'm not sure I understand completely, but we are now. Actually, Jim, I'll let you take it. I'll add to it. I think I'm going to miss.
I think his understanding is, if I put away $100,000 into my foundation, I should just save $100,000 tax, like you dreamed of too. Remember in our presentation, you said that. Unfortunately, guess 91, it's not that simple. You only can deduct income from your donation is a deduction from the income, not from your tax. If that's the case, I think all of us will go do the foundation, right?
Right.
Yeah.
So I would say it's like, regardless, whatever amount you can contribute to the foundation while deducting taxes, it's just money that would otherwise go to IRS, right? For me, that's the difference. It's like, hey, that money is really out of my control. It's amount I have to pay, but now I'm making it have meaning for myself and to allow me to build up the foundation better this year, right? Next year, the year after, I'm going to keep doing it, contributing to it, making this foundation bigger and bigger, ideally, if managed correctly, right?
Yes. And
so
the
it's
next
not a one-year thing.
Yeah, next question for you too. What book did your friend recommend that's interested in your friend?
Oh, I have to. Actually, my wife might know because we actually bought it, but just never read it. But we talked about the content and discuss it, and I have to get back to you on that for the name.
Okay, Mike, you can send me an email, and I will get that book name from Byron for you and send it to you. Okay. And Katie want to talk about auditing risk, right? So I think the biggest issue with the family foundation is self-dealing, and it's a very big topic, Katie. So a lot of things has to be very specific, whether it's allowable. I can't really be listing what you can do, what you cannot do. The most common theme is people say, can I operate a business under the foundation? No, you cannot. You can invest your money because a business is for profit, right? That might not be your question. So a lot of times I really say you got to run the idea over with me. A lot of people has to run their ideas over with me. I have, all kinds of different questions. One thing is, if your whole purpose is put the money away later or take it out for yourself, it's very difficult to achieve. I have a lot of people actually ask me those questions. So I said it has to be charitable minded and tax saving, and to be very mindful if you're doing certain things that you're not sure. So don't do it until so this way you will not have to worry about the audit risk, right? Investment, you can do investment. You can do all kinds of investment. I have people do what's the word? They lend money to people. Those hard money lending. Byron, you want to say something?
Yes, it's called Family Fortunes by Bill Boner. My wife just sent it through. It's on Amazon, so I'll put that in.
Family Fortunes.
Yeah, I'll put it in the ask a question.
Okay, very, very good. Thank you so much. Okay, Jasmine, if a person's W-2 hits the highest tax bracket every year, but not much capital gain otherwise, can he donate a portion of his current stock without selling the stock to lower his taxable income? Yes, most definitely. And you should not sell the stock and then put into your foundation. You should put that stock in the foundation first before you sell to achieve the quadruple tax saving. Okay. OZ again. The self-sustaining rule, that's really is Byron's word, right? His whole thing is if you only spend down 5%, if your investment is over, investment return is over 5%, basically your foundation will not go away, right, Byron?
Yeah, and remember, it's tax-free, right? So whatever amount you're putting in, that amount is growing tax-free. So if you have a dividend stock that is maybe, a good dividend stock that you have that's 10%, that 10% is all tax-free. Yeah. So it really satisfied the 5% drawdown.
Brenda has a really cool question. Can family foundation has beneficiaries who are not family members? How do you define family members? So first of all, family foundations do not have beneficiaries. They have directors and the managers, people who run the foundation. And the definition of family is, I can definitely donate to Byron's foundation. I am not his family. So it's called a family foundation, just more like a colloquial, term. It's just a private foundation. And the band, how are you? I actually have people come to me for not fundraising. They, I do. I sometimes do. Mm-hmm.
And actually, June, one thing since we are talking about that, I think when we are setting up the foundation, there was a question about whether the donations are international or domestic. I just put domestic for simplicity, but if we were to put international, is that a good thing or a bad thing?
It's not good or bad. It's completely doable. So if your foundation want to donate to a Hong Kong school, I'm just making it up, right? It's internationally. And as long as you have all the paperwork documents to prove that you didn't just give it to your uncle, right? That's the joke. Mm-hmm. Yeah. So it's it's not like if you're giving to the Red Cross, it's very simple. So on your filing, you also have to specify who you give to. And when you have
I need to clarify. It's not the donation that the foundation is making, but the donation other people could be making.
Yeah, anybody can give it to you as long as you don't take government funding.
As long as you don't take government funding. So if I have an uncle that wanted to donate to my foundation because
totally fine. He might not be able to deduct anything from his tax because he does not have a U.S. tax return, but he is so nice. He wants to help the U.S. Come on, we embrace that money.
Okay, so that question that was asked really doesn't have an impact, or
I
there's
thought you were donating. Yeah.
Okay, I'm not tripping some IRS rules or money laundering, that type of thing, like that, right?
No. Okay. You're good. Okay. Ben has a question. What is the dollar minimum for setting up a foundation? You mentioned the income tax bracket being used to decide on when to start one, but I'm wondering if there is a minimum amount. No, you can, like Byron set up one in 2021, but he never put any money in there. It's fine. There's no minimum dollars threshold. And I have some people, immigrants, they're coming to the US, but they don't even have any tax liability yet for 2023. They are setting up a foundation just to have the tool ready when they want to do things, right? Just like Byron's case, really good too. He's, had some good luck or not luck, whatever, good problems coming to him. So now he has a foundation. It's an extra tool you have, Byron, right?
Mm-hmm. Yep.
Yeah. Okay. Ivy, can you fundraising from public for private family foundation? A really good question. Technically, a private foundation can take money from anyone, but because it's not public charity, there's a lot of restrictions and rules and percentages, and you might have to schedule a call with me to talk about it. It's very detailed and specific. And Ben has another question. Can you speak about ongoing documentation requirements for such? Not that much, Ben. You just have to do an annual filing with the state. You have to do an annual tax return with the federal, and then do another report with the state if you are in the Illinois. If some other states, they don't have it. California needs it too. Just these, and also make sure your bank statements, you have clear record keeping on money going in and going out. Hey, Mr. Guan, how are you? With family foundation, initially the decision is made by husband and wife, but as generation go by, you can have children and grandchildren and grandchildren. I love it. Have spouse. Eventually, many people want to take a share. Then the decision making in the foundation could be chaotic, and it may ruin the relationship. So Byron said it's going to help us. Now, Mr. Guan thinks sometimes it might also. But again, Mr. Guan, this is not an asset, right? This is not yours. You don't have ownership. So I think in many ways, it's not like I have 10 properties I have to divide in between my children. So this is a thing that we're doing as a family. And I think the people who have a say in this should be someone that's actually actively running it, right? So I can't answer your question, but I think the chances are going to ruin the family relationship is less than you have actually inheritance to divide. Byron, you definitely agree with me, I think, right?
Yeah. I think it's not only that, it's more like I think one thing that's always missing from trust is how we delegate all of this wealth to down generation. But instead of it putting it in that fashion, that perspective, think of it as something that I'm setting up, me and my wife is setting up for our future generations. But not only is wealth delegated to them and opportunities delegated to them, it's an opportunity to use the foundation to bring folks together to contribute to the overall family benefit. So if there's a bunch of money that, hey, these family members of my family is contributing their time and effort to grow the pie, I think it's something that would help. Instead of saying, here's the money, you guys, each family get 20% and go off and never speak to each other again. This is more like, hey, everyone, you guys have a say in the foundation. Come and let's talk. It's more like bringing people together than the other way around.
I totally agree with you. Mr. Guan, if you have questions, maybe I can connect you with Byron. You're both in California. Okay. All right. Philip has a really good question. Can you also donate a share of a private corporation? Yes, you can, but you're not enjoying the quadruple tax benefit because a privately owned corporation stock is not public traded. The value is not easily determined. So the IRS is not allowing the current market value as your deduction for the same year. So Sean, go ahead.
Is this like the pre-IPO type companies?
I guess.
So if you are able to justify the value before it went public, isn't that showing a cost basis?
That's a tough one. I mean, I can do more research, but I remember this says clearly it has to be public traded stock.
Okay.
Yeah.
Okay.
I mean, this is something maybe I should do some more research. Philip, I'll get back to you. Thank you. Yeah, it's always good to dig deeper because they normally not, but there's always exceptions to rules, right?
Yep.
Okay. Sean has a question for Byron. How much time commitment for every year to run the foundation?
It's really up to you. At the end of the day, the IRS really just cares about that 5% to meet the minimum requirements, that 5% draw out. So if you're spending a lot of time setting up events, setting up scholarships and stuff, that is really your problem. So if you're spending a lot of time or spending a little time, it doesn't really matter. It just really, I look at it at the expense level and how much time you put into it. It's really up to you. In my case, we didn't do a lot of work to actually execute on the foundation, but my wife, she is now retired, and so we said, okay, why don't you take on this role? So she will be spending time looking at updating the website, creating scholarship for the local area, you know, and putting more time in. But I think there's no hard requirement.
Yeah, so Sean, I also want to tell you a little bit. Byron didn't spend much time. So we set it up in 2021, right? And he didn't do much yet. 2022, I think not yet. But the good news is this year, I think Byron's wife and Kathleen is taking over the operations of the foundation. So I think she's going to spend a lot of time and make it into a very powerful foundation. But again, to echo back Byron's, it's really up to you. I have clients who are running their foundations really not spending that much time. They spend most of the time investing the money, having so much fun, like Paul, right?
Yes.
and then just giving it out to, you know, his, I think Stanford, your college, you guys all from Stanford, right? He's giving out to the college, but he didn't really spend a lot of time, but it's more like a fun thing for him. But there are also people that they're doing something very time consuming, you know, doing things for community, and that's what they want to do. So Sean, to answer your question, it's really up to you. This should not be a task, a to-do list for you. We only have 4 minutes, so I think everyone has that link to schedule some time to talk to me on this topic, right? So you can, and a lot of you know me. Come on, you can just email me.
Hey, Justine, you want to answer this question? Many people voted to this question that they want to know more on our services for the foundation application, and what does that include?
Oh, okay. So we first of all set up a non-for-profit organization in the state you reside in. So that's the first step. And then we apply for a federal employer ID number. I thought people are not interested, but I'm going to go through that. After that, we will do the 1023 form with the IRS, which I think is a few hundred pages of application. We're going to ask you a lot of questions. We're going to work with you on the operating agreement, the mission statement, your directors, your organizational chart, all these things. And we want to make sure we prepare it in a way that it will be accepted by the IRS the first time we submit. And so far, I think our success ratio on first-time submission is maybe over 90%. There's one or two come back requesting for more information, and we can submit it. And then after the IRS approved the, I think this is where the most difficult part. I have people actually try themselves, and you know, a lot of them didn't go through, but there are still people go through too. But it just takes a lot of expertise. After you get the tax exempt status, we go back to the state to certify with the state that you got it. So now the complete circle is done. So the shortest we've ever done in the whole thing is 3 months. The longest is 9 months to 12 months because people do not respond to us with documented request. Is that good enough, Christy?
I think it's pretty clear.
Okay. Yeah. So I think time is up. There are still a lot of questions. I'm so sorry. But you all know me, so just email me with your questions or request a call from me. I may not be able to respond right away, but you know I always respond. So I will respond. And some of you are my dear friends. I'll just give you a call on the weekends. Mm-hmm. Thank you, Byron. I forgot to thank you. Thank you for your time. I know how busy you are. That you have like 2 jobs and the foundation.
Not that bad. Always willing to help.
Okay, thank you so much, and thank you everyone for giving us the 1 hour in your precious day. And hopefully this is helpful. And let's continue the conversation and to spread the good the good strategy of family foundation. Okay, bye now.